Welcome to the Multifamily 0 to 1 online meetup, where we discuss the best strategies to get started in apartment syndication.
Thank you so much for joining us today on our episode number 22 with Ramesh. We're excited to have Ramesh join us today for our passive investor edition of our Multifamily 0 to 1.
Before we get started, I just want to remind everyone that this is an educational presentation and we're not making any investment recommendation. You should always consult with your CPA and attorney for financial and legal advice.
So with that, let's just go ahead and do some introductions. So again, thanks everybody for joining. My name is Marcelo Cazini. I'm in Houston, Texas, and my background is in IT and software development with an MBA from Texas A&M. I'm a local Houston CCIM member with all the CCIM designation trainings. I'm a multifamily investor, and I also own and operate my own commercial real estate. And I also, before doing multifamily, my focus was in single family fix and flips.
Thank you, Marcelo. Hi, everybody. Claudia Rubio here. I was born in Colombia in South America, and I have an architecture degree, but I've mostly been managing my own assets, my family's assets, since I was very young. And
Sorry, Claudia, you got muted for.
Yeah, I'm sorry. So I was born in Colombia, South America. I have an architecture degree. I've been managing my own assets from my family since my parents passed away when I was very young. So I've been doing business and I've been an entrepreneur for more than 25 years. When we met with Martin, we started buying our own assets also. So I was managing our assets and our businesses. And we've been living here in Houston for a little over 7 years. And we started investing in multifamily two years ago. I also hold a National Apartment Association certification on rental ownership. And Martin, you want to go ahead and
Thank you. So
finish?
I'm Martin Rubio. I'm an IT security consultant by profession. I've been doing this for a little bit over 25 years. I'm still working my W-2 job. Claudia is full-time a real estate professional and dedicated to multifamily. I support her probably 3 to 4 hours every day and on the weekends, but hopefully that will change soon when I can leave my W-2 and go into multifamily full-time. Right now we have around 800 units under ownership in different markets, and we focus very much on asset management for our first syndication here in Houston, 135 unit property in North Houston. That's it. Thank you.
All right, thanks, Martin. Ramesh, do you want to introduce yourself?
Yeah, definitely. Yeah. Thank you so much, Martin and Claudia and Marcelo, for inviting me to have a conversation about my story and also about the multifamily experience and overall. Basically, I came to United States in 1998. I didn't fly in here. I drove in here. You might all think what's happening. I come from India. It's right. I was living in Toronto, Canada for a couple of years. So, then I moved here, and I live in Connecticut, like northeastern part of the United States. Most of you, from Texas might feel too cold or too much snow in here, but we like the 4 seasons, and that's why we're still here. And I moved in here in 98, and we still live here. I have a daughter and a son. She's a senior in college, and I have a 6th grader, going to middle school. So pretty soon. I've been working in IT for almost like 18 years, with 14 years in one company and other companies in 14 years. This whole multifamily experience kind of came into play when I switched my first job, and that's where everything started, which we will be probably going over pretty soon. I am like GP in, I know when I sent it to Martin, it was like 1,500. Now it's 1,800 plus. We just closed the deal in Austin. So almost like $160 million in Atlanta, Indiana, and Texas, pretty much. And the more important thing is I've completed like 5 projects. We have completed a full cycle, 2 as LP and 3 as a GP, ranging the maximum returns being 43%. So there you go. I think this thing really works, right? And that is my short story here.
All right, thanks, Ramesh.
Why don't you tell us a little bit more about how did you get into multifamily and what's the most attractive thing from multifamily for you?
Yeah, actually, I come from a business background, family wise, so always kind of in the DNA. So when things hit the fan during 2008, I saw, okay, single family is like getting a big hit. So things are going down. So definitely anything and everything that goes down has to come up at some point because it's cyclical, right? So based on that understanding and analysis, I said, okay, let's try to do something in real estate in 2008. So 2008, we just bought some multifamilies locally, like 2-3 families, and did a lot of flip in Connecticut. Obviously, the prices are very high, taxes are very high, as most of you might know. It is not a great return on investment when compared to others, but still it worked out much better because we came from a downturn. Uh, it really started in multifamily, like apartment buildings. For every one of us, we have like a breaking point or a wake-up call, however you want to call it. Things happens at some point in life that triggers and you run faster than ever before, right? I was working for a company for 14 years when things were, and after the depression happened, every year it might be like, okay, there's going to be such a layoff coming. It's coming. We were never part of that list. I was like, okay, I was hanging in there for like 3, 4, 5 years. 2013 hit, and probably I made it to the list, which is very good. Sometimes when you turn back and look at it, yeah, it was pretty depressing at that point in time. But we always used to call you're unhired from your job, and that's exactly what happened. And obviously, my daughter was going to high school. She was a freshman at high school. So 3, 4 years from there, she's going to go to college. We all, as family members, think about, okay, how am I going to meet the college expenses? How am I going to get a new job? And that is where, based on your previous experience and everything else, it's really very interesting. That's right. I had money to buy my van, and a friend of mine who I used to work with her for 14 years, and most of you might know her as well in the real estate industry. Like Maureen Miles and I used to work together for 14 years. In the same building, and she got kind of unhired at the kind of the same time, and we were talking, having coffee back and forth, and she said, you know what, I'm done with the corporate jobs anymore. I'm just going to do the real estate full time. Probably I was not there at that point in time, and I said, you go and do it. I'll start doing LP with you. We will do all the wonderful things that we can. First time is she raised money, and I said, how much you have? I said, what? Right now I have only 25 grand, which I saved for my van, which they offered me with 0%, and let me get started right there. And that is how this whole experience started in the multifamily space, which was, things happen for a reason, and every now you just have to look back and be proud of yourself that you did what you did. End of the day. And that took a lot of leaps and turns, and probably for the better. Started with 1, went on to 2, 3, and everything else.
So what about multifamily is for you that is the most exciting thing, or what interests you the most?
No, actually, but the important factor, probably, most of you, since you're all in real estate and everything, you might know, but I come from a different background, not only from IT, as personally, I've done a lot of different businesses in life, right? So I'm also a farmer risk management guy for an insurance company. Yeah, I used to work there as a risk management guy. So basically, my factor is how do I protect my capital first? Forget about profit or everything else. So when you look at all the different aspects of capital preservation, multifamily, even within the real estate industry, stood out at the top. Right? I did a lot of analysis, single family, commercial real estate and everything else. When we started doing it, we were doing a lot of flips and everything. But when you do a real good analysis of things, out of all the real estate products out there, basically even right now, right? Because three basic things we need in life, right? Food, shelter, and water. Right? You can't live without it. And this is one among them. So basically, people, you can build everything, and always, every town, especially in the United States, every town controls inventory. Like they don't build too much, so that everything comes under price. So everything is like controlled process. So based on that analysis, it really stood out at the top, and that is one of my liking from it.
Awesome.
Okay.
Awesome.
So usually when we talk about people that are focused only on the passive side, they haven't syndicated. They explain that the most important part for them was education to get to a point where they felt comfortable doing that first passive investment. For you, it was more on your experience from businesses, but talking about the specifics about multifamily, did you have any external education that you took or books that you read or it was just play it by ear and go with your friend and see how she did things?
Actually, I don't know. I'm kind of a guy who kind of learn on the go kind of thing. So basically, from the Great Depression, I after started doing small things over here, I kind of analyzed and probably did a lot of videos. I'm not, unfortunately, I'm not a guy who reads books all the time. Maybe I might hear some, videos or anything like that, but still, uh, you know, I just go out there and look at a lot of things and kind of gain knowledge. It is always a learning curve. We all learn every time when we speak to somebody else, when we go and attend a conference. There's always learning. What we know is much less than what is out there, and that is one of the reasons you always have to go out and look for information. And that is how I kind of figured out all these things about that.
Okay.
Awesome.
At that time when you invested those first 25K with your friend, were you focusing on the market or the type of property, or was it more like, I trust my friend, she's going to be a good sponsor, whatever she finds, I'll invest?
I think the latter, right? Because we know each other for 14 years, and I know, she will make it happen. And it is a pure matter of, that one of the things, even right now, I look at one of the premier qualifications with operators is that honesty, the integrity, and the trust, right? That is more important because it is my money is their money is my money kind of thing. So it's totally integrated. So that is the most important factor. We even look at people, and that is exactly what I was betting on, and that is how we built the relationship beyond that.
Okay. We're getting some questions from the chat related to when in your introduction you talked about the total return on the ones that you have done full cycle. I think you said 43%, and someone else.
That was my $5,000.
Okay. So you did 43% in how long?
In I think 2.5 years.
Okay.
And 43% a year in 2.5 years. So you're talking about kind of double the money, more than double the money in 2.5 years.
Okay. Someone, B Sad is asking, what's the average rate of return you think you're getting per year on all your investments?
If I'm, if I do, I'm also, I've done masters in mathematics, so I know the numbers pretty well, and I know simpling, compounding, and everything. say, for example, if I use my 401k money, it is a compounding impact, which will fetch us like, on an average, easily like 25%. Okay? Because I'm reinvesting my money all the time, and I'm not taking any penny out. If I'm doing it on my own, you're talking about like 20%, because on an average of 20%, I would say. But the thing is, some of these numbers are as is, right? You have to see until it's sold. So when it's sold, the numbers could completely vary depending on what the sale price is.
Yeah.
And one of the question, in case you want to speak, what has it? I mean, maybe your worst performer. What was your lowest return?
Actually, we are sitting on one property, and as you guys said, it's always good, bad, and ugly kind of things, right? So we are sitting on one property which hasn't been distributed for 18 months, right? Which is welcome to the real world, right? Because the reason is one of the things that we even went in, personally myself, I even went in with an assumption that's going to happen because the location was not a great location. Usually we do look at locations when we go. And I was even visiting this property. Location was not a great location, but the price kind of made us not to walk away from it. So the price was a sweet deal, right? Yeah. And that was said, you know what, maybe we might make money when we sell it. And maybe we might not make a money. Right now, even that worst performing property that I can classify as could be the jackpot out of everything else eventually. But I can't prove it right now, right? So, right now, I can give you a snippet of it, right? On that property, we are sitting at 6.1% interest rate. Our 18-month prepayment penalty is closing end of November. So if we go and do a refi, they're going to kill it. Because 6.1 will become 3% or something.
Exactly. Yeah.
And then you can return some capital, and you're going to make more than what you promised, even on the return. I mean, the distributions every year, and also you're going to make a killing at the time of sale.
Okay.
Great.
Leila is asking. You talked about the way the market is cyclical. What part of the cycle do you think we are right now for multifamily, in your opinion?
Multifamily, I'm still thinking there is some more room to go up and down, but it's all, one of the things that I always tell people is it's like dollar cost averaging in stock market, right? You cannot wait for a sweet deal because there's nothing is called a sweet deal. Who's going to predict tomorrow? Nobody. We can all assume with great assumptions, but no one can predict what's exactly going to happen tomorrow. So you keep doing it. But as far as I think, once the forbearance comes into a closure, and if the federal government and the state governments are not going to act on it, that is going to have another dip, probably on inventory, on foreclosures, both single family and multifamily. That once it's all supply and demand, so the prices might even come down a little bit. And then everybody kind of doing data analysis, kind of foreseeing that. But if the government comes back and throws away a lot more stimulus into the whole deal, it's a totally different picture. So nothing, you can only assume and presume a lot of certain things, but you can't really come to a conclusion. So I would keep doing what we do and do a dollar cost averaging. And at the end of the day, if I'm averaging 16-20%, I'm more than happy.
For sure. Now, there was one question for earlier that I think we skipped here. If you end up analyzing single-family new construction turnkey rentals in the Great Belt States, Marcos was asking that.
I'm sorry, can you repeat that question? I'm sorry.
So the question for Marcos was, when you're choosing investments, if you end up analyzing the new construction turnkey rentals, single families.
Basically, I think if I'm understanding it correctly, I think he's referring to what I said before on the inventory of supply and demand kind of thing from the towns. Usually, zoning in each town allows certain number of new builds to happen based on the population growth and the job growth, right? So say, for example, right now, I can give you an example, right? Right now, Connecticut is it was never a state that we would invite people because of taxes and everything else. New York people are fleeing from New York right now. And where would they go? They would go to New Jersey, which is already expensive. So they're looking at Connecticut becoming cheaper for all New Yorkers because it's less expensive. For somebody who's paying a 2-bedroom condo in Manhattan would buy a house in Connecticut, which is probably the same mortgage they might pay end of the day. So it is all the supply and demand. So depending on the marketplace, obviously the single family homes can come into play. And I don't know exactly, that was the question he asked, but maybe that is how I understood if something different.
May I clarify?
Yeah, please.
Sure. When you were speaking earlier, you said you looked at various markets to help determine whether you were going to get into multifamily or this or that. And you decided on multifamily based on your analysis.
Yeah.
What I'm asking is, did your analysis at the time include analyzing going into new construction, buy and hold single family turnkey real estate, and look at the ROIs based on those investments compared to multifamily and others, and kind of what were your findings in that kind of analysis?
Okay, thanks for the clarification. I didn't get it that way. Yeah, and actually, obviously, it was the main factor was the ROI, right? So, once you scale it up, obviously, you can leverage much more than usual, and that is where, out of everything else in the real estate products, I felt multifamily has a even better chance based on stability, capital preservation, and leveraging assets, and also end of the day, like a supply and demand, most importantly, the ROI.
And I think there was a question from Jasprit here. What when you're on the deals that you're a GP on, what typically is your, if you feel comfortable sharing, what typically is your percent ownership on the deals that you're GP?
It depends. It depends on the deal. The thing is, everything is negotiable. That's what I tell people, right? If I tell you 5%, that's not might be true for somebody else who will be willing to give it to you for 10% kind of things, right? So it all depends what your role is, what the value you bring it to the table, because we have to make ourselves more valuable. Then people will sit down and talk to you and negotiate with you as well, right? I just walked out of some negotiation conversations before this call, so it's nothing is set in stone. Everything is flexible. Everything is negotiable. But it all depends what the value I bring into the table.
Yep. So Marcos was asking a follow-up here. That if the ROI was much better in the analysis for the apartment compared to the new construction single family, or if the numbers were close.
Yes, absolutely. Because especially, I think Marcus is leaning towards the new construction. New construction, it is much safer investment, but the ROI is not that great. So and also depends on the market too. There are a lot of factors. I don't want to say one answer is going to fit right. Also depends on the markets, right? If you're going on high earning, high income markets, your profit will be much less. And if you're going on emerging markets, your profit might be a little bit more. So, but no matter how you slice and dice, multifamily kind of will stand out at the top here, or will be one of the ones standing out at the top.
And I think one important comment in there is that the risks for development are very different from the risks in multifamily asset management and acquisition. So whatever risk you decide to take, you need to be educated on that risk. And I think it's an easier path to learning to understand those risks in multifamily than to understand the risks on development. So if you're already educated on development and you're a really good operator, it might be safer for you to go that route. If you're starting from, let's say you do fix and flips, or you had long time single family rentals, it might be easier for you to get educated in multifamily. So it also depends on that path, I think.
Yep, for sure. So one question from Rafi here was, how do you judge what percentage of your liquid assets you should put on a deal if you're passively investing? Or maybe how do you decide how much to invest on a deal? Perhaps would be a different way of asking that question.
Now, I know if you ask me personally what I would do, I would put 100%. Okay, that's different. I wouldn't recommend that, right? But the thing is, it all depends on how much confidence you are, how much, because I'm not trying to tell everybody that multifamily is the solution for everything. No, right? There are a lot of assets that, as I told you before, we are coming to a conclusion based on what we know. If we know like 5 products or 10 products, then out of the 10, we are telling the multifamily kind of stands out at the top. So there are a lot of other avenues as well, but this is the safest avenue to get to the final destination of financial freedom. I would say how much you're comfortable with. Say you have like $100,000. Okay. Yeah, I want to preserve for 3 months of expenses or 5 months of expenses. Then I can go and put 75,000 and also put that money to work, because that is going to bring you cash flow every quarter, right? It is going to add to your reserve of $25,000 starting 3 months or 6 months, depending on the operators after the stabilization period. So everything, basically, as a passive investor, right, you have to get started first. If you getting started, then make your plan, put an action plan. And I always tell people here, to my friends, hey, if I'm doing certain things on a daily basis, I want this to be one of them. Thinking about it, what am I doing about it, right? We don't want to kind of close the door and say, no, I can't do this. That is like you're basically closing the door. Instead of saying I cannot do this, if you ask the question, how can I do this, then you're opening the door and finding answers beyond it. There are a lot of ways that people really, it's all about how you think the whole process. And then your 75 will become 100 will become 150. That's how you grow your network.
Yeah, great response, Ramesh. Manish also asks, and I think we're gonna go a little bit deeper on this, but he's asking, how do you decide to invest in any deal?
Yeah, there are a few factors that I look at it. First is the operators. The second is the location, and but nothing is set in stone. As I already gave you an example, right? Even though I look at locations, we went against our own thoughts because we put our bets saying that this is going to work end of the day. So we will do a lot of underwriting analysis, with the operators. We do a lot of the usual data analysis, like the job growth, the population growth, the crime rates, school districts, and all those factors, right? And then you also compare, like if you have like 2 deals, 3 deals at the same time, we compare and see which one is better, which one is the best out of the 3, and go with the best ones, right? That is how you can protect your money, your investors' money, and also make sure that asset performs end of the day.
Right. Okay. So next question is from Philip. With COVID equalizing all USA markets and future investors' returns and expectations, how are you now determining choosing your emerging markets?
Yeah, and I think in contrast with that question, I think Eric is saying that COVID is not equalizing markets, but is actually showing the markets with the most strength and weakness. So what are your thoughts about the 2 questions there? Just wanted to put them together.
Yeah, no, actually the thing, it's very interesting. It's right, out of the blue, we get a pandemic and the entire thing is being tested, right? We were never, even companies never thought that every one of their employee can work from home. Do we have a bandwidth? Do we have all the technologies to support that? Everything was scaled up within like 2, 3, 4 weeks. The people went from, 2 people company working from home to 2,000 people working from home, right? So everything is, and it kind of not changed the landscape, I would say, but it really kind of put a lot of things in perspective. Things which were all questioned before is doable now, right? And which is very interesting, because that kind of puts all those cities in a bad spot, because cities were more expensive. You cannot live in Manhattan, you cannot live in LA, you cannot live in San Francisco or something. But now I'm going to be working, because I know a personal family friend who moved out of Manhattan because 2-bedroom condo in Manhattan costs like up through the roof, even for renting. If you have 2 people, 3 people working from home with all the meetings and background noises and everything, you can't even function. So everything is being challenged, right? So, but in a matter of time, it's all supply and demand for any product, like anything else. So technically, they have just migrated to suburbs or neighboring states or something like that. But eventually, those markets, right now, it might be underwater or maybe up for grabs. But eventually, it will come up, and everybody has a different thinking process. We have a different thinking process. Millennials have a different thinking process. Generation X has Z has a total different thinking processes, right? Nobody wants to commit for everything, and that's one of the reasons multifamily is doing great. And those are the factors which will have the emerging market will have their say. Whatever the markets that are getting wiped out a little bit will also kind of come back, but it will take its own due course of time.
Mm-hmm.
And I think you can see that also in the way syndicators are starting to move to new opportunities creatively. And for example, we're looking at the suburbs, because people are moving away from the big city or from downtown. We're looking at properties that have larger units, as you said, Ramesh. The person who is comfortable in 2 bedrooms now needs to work from home. Maybe now they look for a 3 bedroom. And one of our main focuses, and that's what we're doing right now for our next property, is we're looking for workforce around the property that doesn't have the opportunity to work from home. Like, for example, consultants like me, we can work from anywhere, right? But if it's a hospital, if it's medical center here in Houston, or if it's something like that, the nurses and doctors and technicians, they can't work from home. They have to go there and run the machines, do the tests. So you have to be selective on which type of jobs you want to support your property, not any type of jobs. You don't want to say, okay, there's 25,000 jobs in this area. Now you have to go dig deeper and figure out, okay, where are those 25,000 jobs really coming from?
Yeah,
You know?
actually, the so-called essential workers, right? They have to be on the job. Yeah.
Yep.
Now, Ramesh, in keeping with the theme of our meetup here, which is getting from 0 to 1, and we do get a lot of folks who maybe they're looking for their first passive investment deal. They've heard about multifamily, they're convinced that multifamily is the way to go, but they're trying to take the jump and do their first investment. So given where we are now in the cycle and the COVID era and everything, what would be what is the best advice that you'd give for someone who's starting now and they want to do, maybe they have 50,000 that they want to put on their very first deal? What would be your best advice for that person?
I would say get started today, right? The thing is, we can do a lot of analysis, paralysis, and never get started, because everything there are 1,000 reasons I can come up with not to do it, but I just need one reason to do it, right? So we just have to, take that first step, do who you are comfortable with, right? To who you're trusting with, especially, that is what I did. That's exactly what I did, because I had no idea about multifamily when I did it, right? I said, somebody came to me, and she knew what she's talking about, but she's also pretty new to the multifamily space at that point in time. Now she's a superstar. That's different, right? But at that point in time, but I said, you know what? I trust her. I can bet any money on her. let's try to make things work. And that is exactly how I would recommend to people, because you have to have one valid reason to move forward, and that could be the best reason to move forward, because your judgment is on the line. And I'm not trying to say everything's going to be better and prosperous by doing that first deal, but make sure you do it with a person who you're very comfortable with and who respects your dollars more than theirs. Then that definitely you will not fail.
Yeah, for sure. So, and for that person trying to analyze a deal, do you have anything that, again, focusing on that person who perhaps is trying to get on their first deal, on their second deal? Do you, you mentioned you look for operators, you look at locations, but you do your own underwriting there. Do you have any tips for what perhaps to look into the deal from an underwriting perspective, and how to some points that you look for from an evaluation that would compare, especially, I mean, we're starting to see perhaps 2 or 3 deals now coming to the market. New syndicators are getting ready to syndicate again, even though there's still uncertainty in the market. How, if you have 2 or 3 deals in front of you, what are some of the analysis that you do from an underwriting perspective, if you can get to that detail?
Actually, I would, for a person who's getting started, I know some of us knows all those details and nuances, but for a person getting started, I would not go too much into it. I would look at all the basic factors like location, the operators, and the job growth, potential population growth, crime rates, school districts, and all those factors. And I also ask, whether what is the total ROI based on their underwriting, and what are the factors you guys are considering, right? What are the factors? What is the capex dollars? How much it has been spent before, and what is the value add you're doing? Is it real? Say for example, somebody comes and tells me right now, we have 2% rental increase for the next 1 year in their underwriting. I said, thank you, bye bye, I'll see you later, because that's not happening, right? So there are certain factors that you want to ask as a basic question, right? And see how they are really underwriting. And most of the people in the industry, you have to be, as far as I'm concerned, right? Especially with multifamily, I shouldn't say this, but still, there are excluding the market corrections, right? Somebody has to make really bad decisions, really bad operations to lose their capital, because those people will come to know, will find about it, and unless there is a valid reason behind somebody's not distributing, then those are the things. What is your track record? What is your best previous performances, right? Those are the factors probably you might ask, until otherwise, because even personally myself, I was like looking at underwriting in depth after my like 7th, 8th deal. That's it, because I was learning things, and I know what it is, but I was not able to capture those. So that is one of the reasons I just went with somebody. I know it is not easy to trust somebody and do it, but friend's friend or some connections, somebody trusts somebody, and okay, I can go and bet on that person as well, kind of thing. And also better also ask basic questions. I'm not saying just throw your money kind of thing, but also ask the basic questions and see how how it's going to be performing down the line. I don't want to say people want to be focusing on underwriting in detail, because once you start going underwriting in detail and do an analysis, you have I would say personally, you have like 60-70% chances you will not do it, because there could be a lot of factors, ups and downs, and you will learn these once you keep doing over and over again. Then only you will get better at it. I don't want to expect people wait until you get better and start the first deal.
Ramesh, do you recommend for people starting out to get into an educational program about multifamily, or do you think doing it on your own is also viable?
No, actually, I would recommend both. depending on individual's choice. But my personal request to all of you as first timers or even ready to start, think about this 5 days. I mean, 5 minutes, all 7 days. What now? How am I going to do it? What did I progress then yesterday? Then you will hustle and you will get started. If I'm not going to keep thinking, why am I brushing teeth every day? Because somebody told me to do so? No, it is part of the science, right? So same way, when things are not done every day, you lose track because you can get into the comfort zone. Most of the people are here working. If they're working, yeah, you have kids, you have family, you get into the routine, you never get that 5 minutes. I always tell people, guys, if you don't have a 5 minutes, you have a 5 minutes when you're taking a shower. Okay? Get it right. Okay? Think about it. You're not going to be thinking about in Paris when you're taking a shower. Think about your finances when you're taking a shower for 5 minutes and get your act together. Ask yourself, what have I done today then better than yesterday? Then you will get started. Once you get started, you will get to go to the next one. Then you will go to the fourth one, fifth one. That's how you progress.
Yeah, I tell Claudia that acquisition of new properties is like a football game. Everyone thinks it's just a couple passes and you get 100 yards, but it's actually a bunch of downs.
I know. No, it's nothing is easy in life. Nothing is free in life, right? So, you have people are, people who are successful. Do you think that it happened just like that? No, they are probably working their just to keep going crazy, like probably 24/7. Because I know I work with friends who text me like 1 a.m. in the morning and 4 a.m. in the morning. People are working crazy hours, and that is how. That the thing is, it is their push. It is their hustling every day. They said, you know what? If I'm not making a deal, I have my personal goals. I tell my investors who are I'm in the process of starting a passive investors millionaires club right now, and I tell people, just you cannot not think about it, and everything is going to happen tomorrow. And that is one of the reasons I I kind of came up with the tagline: if I cannot help myself, no one can help me. Right?
For sure.
Yeah. So you just have to start yourself.
So true. Yeah. We have several questions here.
Maybe I'm also talking too much, Claudia.
Wow, no, we're fascinated.
That's the idea.
Yeah. So from Philip, in this intro, Ramesh mentioned he just closed on 300 units and he's now at 1,800 units. Great. Can he describe or highlight any interesting aspects of closing on his last property, any syndication issues, banking issues, underwriting assumptions?
Yeah, actually, it is always a team effort, right? When we work as a team, we divide and conquer. And we, one person works with lending, one person works with all the investors and investor relations, we due diligence. There are a lot, it's always a team effort. As long as the team is focused on their own tasks, we just even have a task profile that gets submitted every day. We got to complete it. It goes up and brings me the next task. So you just have to make sure you are being even for these conferences that we're working on, it is not easy. So it's a lot of work, and we have to be on top of things. But when you have a good team members, when you have that is where you find success.
Right.
Awesome.
Any other? Yeah.
I think
we are not missing any questions from the audience.
The next one we have here is on.
I had put one in there around rent rate increases. That there are certain markets that are seeing that. What do you think about that?
Yeah, actually, that is as I said before. It is economics is pretty cyclical. So whenever there is a recession or depression, the governments always wants to step on these kind of things. Until that time frame, nobody even thinks about it. So basically, I personally feel it is a logistics that will stay for some time, and Especially say, and New York City is a prime example. They have all kind of caps right now for rent increases. Come on, guys, nobody's renting. What do you mean you have rent increases, right? If all the landlords are willing to give it for any amount of rent, what is the big deal? It is like, yeah, we're going to tax Amazon, but Amazon doesn't want to pay any taxes. How does it matter, right? So that is how.
So the other half of the question, basically, what I'm trying to ask is, you mentioned that if you are looking at an operator or syndicator who says that they are planning to have 2% rent increases year one, starting now, let's say if they buy something by December, and you just say, all right, thanks, sorry, goodbye. I have no interest in looking at it because you're not underwriting it properly.
Yep.
And I'm just saying that there are certain markets, and I can attest to that personally, where even my rentals are seeing a massive amount of rent rate increase through this COVID pandemic, just because of the amount of inflow of population into those areas, whether it's Indiana, whether it's certain areas of Texas. They are seeing rent rates go up through June, August. And what do you think about that?
No, I agree with you, but the thing is, when you're doing a conservative underwriting, right, you just have to keep in mind your delinquency is also going up right now. So how are you going to compensate that, right? Your vacancy is going up as well, right? So it is not like we have no idea what the forbearance is going to bring it up in March, April next year. So there are a lot of uncertainties that we are dealing with. At that point in time, no matter which part of the United States right now, I wouldn't recommend or not even anything more than 0% increase, rent increase. Even if it's happening, that should be a cushion for me to handle all the other deltas that I'm facing. I don't want that to be an underwriting, and my delinquency goes up, my vacancy goes up, then we have a bigger problem to deal with. So there is nothing, even if it is happening, I don't want to see it there, because that becomes a cushion for reserves.
Right.
Yeah. And usually you talk a lot about occupancy when you talk about the properties. First thing you used to talk was about occupancy, but nowadays occupancy doesn't mean, because that's how many people you have in there paying. But now that doesn't mean how many people you have in there paying.
Actually paying, yeah.
Yeah, if you talk to a lender, and Henry can attest to that, in the end, underwriting for the loan, they don't care about your occupancy. They care about your collections.
Yeah, exactly.
Yeah. How much money are you really collecting? Mm-hmm.
Tell me about the lenders. I know, Henry, what we will do.
Yeah.
I'm sorry, Henry.
No, it's okay. Yeah, Martin's absolutely right. So in terms of underwriting, they're going to look at the trailing 3 net rental income, which basically is the money that you actually receive. And there are adjustments that are actually being made right now. If the last 2 months look poor, then maybe the lender will annualize a trailing 1 or a trailing 2 instead. And so, yeah, absolutely
actually, it's a very good thing you brought it up, Martin. We just we're reviewing a couple of deals yesterday and today, and if the T3 is not the next T12, it's too hard even to go and find a lending, which is exactly what Henry's saying.
Good. Okay, so going back to our questions, Ramesh, you've been doing this for a while now. So with your experience today, is there anything you would have done different?
Probably no, because sometimes I think I personally also feel a little bit lucky, because I started with a good friend of mine. Maybe not a lot of people would have that as a starting point, and obviously that was bigger motivation to begin with. And one of the things is, as I said before, I really started multifamily to save money for my daughter, for college, right? Mm-hmm. That was my initial stepping stone into the space. But eventually, right now, I'm doing this full time for the last 2.5 years. I'm not working anymore. No more W-2 jobs. So that gave me a lot of leg room to do what I'm doing it today. So if I look back, even if I would have changed anything, I would not have seen much of an impact.
Good. And what's the worst thing that has happened to you in a deal or
Multifamily
yeah,
syndication horror story.
Not getting a distribution for 18 months.
yeah.
But
But
I'll be hitting a jackpot later. Yeah.
yeah,
In this example, I mean, I think Henry actually posted this earlier in the chat that sometimes that's where we start seeing the difference between good syndicator and bad syndicators, right? Where some syndicators may just go silent and stop communicating with you because something is not going well. But in this particular deal, do you feel like the syndicating team kept communicating and keeping you?
Yeah, I know. I don't let them go quiet. That's a problem. Yes, right. we are on their toes all the time. So we make sure like, communication is done, and we also inform our investors what's happening on the ground, on a person. Forget about the email. I even call people all the time and talk to them and say, okay, guys, I know email is a message, but this is exactly what's happening on the ground, and just like your money, my money is sitting there as well. So I'm not going to let this go on the sidelines, but it's definitely the opportunity once it turns around, it's not too far. We are already in October 21st, November 31st, that's eligible for a refi. And probably within 2-3 months, we should be able to knock it out of the ground. Yeah.
mm-hmm. Mm-hmm. Okay.
All right, folks, anybody have any other questions that you feel like we haven't asked Jaspreet?
I think we missed one up there from, I think was from Rajesh, about the Austin market. Which compared to Dallas and Houston, I think the short answer is yeah, Austin is more expensive. I think because of all the population growth. But if you wanna talk more about it, we can talk offline. We can give you directions to brokers that manage that area, and they can tell you a little bit more. If we miss any other questions, please ask them now, or you can shoot us an email later to Marcelo or us, and
Or
we can
Ramesh.
help you.
Yeah, and I also want to, and if it's okay with you, Marcelo and Martin, we have a passive investor conference coming in November 7th and 8th.
Mm-hmm.
We have a great line of speakers, and if you want to send it to this group, probably Martin, you can email them my special code, which will give them extra special discount to join in as well. One of the things that we wanted for that conference is for people to get motivated and also know about all the different products. We're not going to, the reason, there's a lot of concerns right now, it's right, why multifamily kind of things, right? So we're going to talk about self-storage, senior living, what was the third one? And like mobile home parks, multifamily, all different products on that conference, so that people can gain knowledge. They can go back and learn some more, and end of the day, they can decide what is the best product for them to go after. And obviously, since we're all multifamily, that might still stand out what we believe, but we also give them an opportunity to learn about all those different products, tax strategies, asset protection, and I'm going to be talking about financial spirituality in that conference, which is very big favorite topic of mine. Yeah. So everything, as I strongly believe, happens for a reason, and we have to make that work, because that is not going to happen by itself.
Okay, and if you guys are interested, we just posted on the chat the information about that conference and the link. You can find out more over there.
And one last question here. So from the 20% average returns that you mentioned, Dee was asking, how much of that do you feel like it's distribution versus capital gains in general?
I would say like 8 and 12, or 9 and 11, or something like that, on an average.
Okay, very well. So with that, I do want to share a couple of things here with everybody. So I mentioned on the chat earlier, so if you guys, we also have, on top of multifamily021.com, we have our YouTube channel. So if you want to sign up to that, then if you miss a meeting, you can go ahead and watch it again. And so I posted the link there, but it's also on the main page of multifamily021.com. And we appreciate the folks who are new here. So I just want to remind, there were some questions about how this meeting is structured. So typically how we do this is we meet always on the first and third Wednesday at 7 p.m. Central. So the first Wednesday, we focus on how to get started as a syndicator. So we always bring an experienced syndicator for us to ask questions. And then on the third Wednesday, like today, we bring an experienced passive investor for us focusing on how to get started as a passive investor or how to get better as a passive investor. And I always tell people that want to be a syndicator that the third Wednesday is also important for you to understand what's important for passive investors, right? Because you cannot be a good syndicator if you don't understand what's important for passive investors. So for the folks who are new, I hope you join us again for first and third Wednesday. Hopefully you already signed up on multifamily0to1.com, and then you can get notified of the meetings there. And
yeah, Marcelo, yeah, I just want to, probably conclude by saying this. It's right, as you said before, it is very important for people to take the first step. And every one of us who have been probably successful in this industry would have done passive investing for at least 3, 4, 5 years or more. And people would have gained financial freedom. Then that gives them more authority and confidence to go after syndications themselves. So sometimes, we just get very eager and say, okay, I want to do syndication to begin with, right? And that is, I'm telling you right now, it's a lot of work. Okay, sometimes I even think about, okay, you know what? I'm so satisfied by being a passive investor because that is where most of my money comes in anyway. So why am I like sweating and doing this kind of thing? And that is like how you're being a landlord and handing a single family homes kind of things, right? Kind of a same scenario. You're becoming a landlord end of the day by being a syndicator or a GP or as part of the deal. But a lot of people do like it. Don't get me wrong at all, right? It is their passion to serve. This is a very unique business where you get a lot of satisfaction and passion in doing so. And that brings more value to a lot of people. And right now, I'm also happy this industry is getting opened up pretty widely for larger audience in the last 2, 3, 4 years. And that is more welcome. And SEC's kind of relaxing guidelines and all those things are happening at the same time. So much more to come. And we are at a very good time of the market. As we saw in 2008, right now, it's like where we don't know whether we're at the bottom or a little bit still going down or something, but still overall, when you look at it, 5 years from now, it doesn't matter what you did 2020 July or what you did 2021 July, doesn't matter, right? You will be still on the upside. So I would not wait for and ask people to wait for a total dip. Nobody knows that. So do an averaging and then get on it and do an average process of the day. Hustle, you will get it first one, then keep going. Nothing is going to stop you.
Yep, for sure. So I want to share, hopefully the folks saw Ramesh, your email address. So hopefully it's okay if they have any questions to reach out to you. And for the folks who are asking for the conference link, so this is a conference that Ramesh is hosting on November 7th and 8th about passive investment. So I have the URL there, and I also posted on the chat. If you're interested, please take a look.
Thank you for watching this week's episode of the Multifamily 0 to 1 Meetup. Join us live the first and third Wednesday of every month.